Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, the last thing, I actually do want to show one other thing on this before we open it up for questions. We have a virtual trade tool. Go to Toolbox and then Virtual Trade. And let's say this is something that's new to you. You have the ability to actually paper trade this in a virtual account at OptionsXpress. This is a free service to where you can actually practice this, see how good or how bad you are at trading currencies. Now, the platform itself, it's nothing too special here. It's pretty much the exact same thing, so I don't want to spend a lot of time showing it, but the point is this. You could do the same thing with currencies and see how good or how bad you're doing within a specific strategy that you're using. So at this point in time, what I would like to do is go ahead and open it up for questions. So if you have any questions, feel free to type them in the chat box, and Steve or myself will do our best to answer them to the best of our ability.
First thing, Mike, I want to say is you obviously did a lot of research because it's very interesting to see some of the correlations and some of the non-correlation. I think that one point was really excellent when you looked at the U.S. stock market against the YUK or the U.S. dollar yen. Everyone, I think last year at this time, everyone was saying that the correlation was so high, and I guess in the last 6 to 9 months or even year, we've seen very little correlation or much lower correlation. So that's interesting. And I guess your other point is that these correlations will change. In fact, I think if any of you have done any research or been reading about what's going on in the world and these very sophisticated hedge funds, that's a bit of their problem is that they made these correlated trades, and most of these trades are not working out as they would have expected. So as Mike had mentioned, please consider the risk. In fact, that's why that one spread he just showed you, you saw that you had limited risk, you had limited reward, and really that's always up to you. But some really excellent points there, Mike, on just looking at those correlations. Question, Mike, how do you use correlations to make money? How do you look at it, Mike?
Well, in terms of making money, one thing that I want to say, like when Steve and I were talking about doing this webinar a few months back to get it set up, he was just saying, well, as you go through this, and I personally do. I practice what I preach. I have an OptionsXpress account, and I'm an active trader. Don't get me wrong, but he was saying, I don't think you're going to find a ton of correlations as you go through this. So naturally, of course, I wanted to be the contradictory type person and just kind of up for the challenge, looking for correlations. And right now, my eyes have gone buggy trying to find these. I haven't found a ton of correlations. But in terms of the question of how do you use the correlations to make money, one thing that, and full disclosure, I didn't actually make this trade, but when Steve and I were in Canada earlier this year, and we did see a correlation of, you could have argued and looked at the fundamentals of GM, because even GM has been the fundamentals of GM have been in question for a long time. The fact that GM was still doing okay, at least, one thing that you could have done, and I'm fully admitting this, I didn't do this, hindsight's 20/20, I'm being a total Monday morning quarterback, but one way that you could go ahead and look at this is you could say, okay, well, what's holding up GM right now? Is it the fact that the dollar is doing so poorly? You could have possibly bought some puts on GM, or you could have maybe thought, well, maybe the dollar's overbought, or whatever way that you wanted to look at it, or I'm sorry, that the
dollar's oversold, yeah.
Right, the dollar's oversold. You could go that route, whatever way you wanted to set it up. So it's hard to say exactly how you can use the correlation to make money on it, but if you do find something that could work, then by all means, go for it. The other thing that you may want to consider doing is, let's say, for example, that you're looking to trade an oil stock, and your oil stock is something to where you're dependent upon the price of oil going higher for the value of the stock going higher. One thing that you could do is you could do kind of a pairing strategy to where, let's say you wanted to hedge yourself a little bit, maybe buy some puts on oil and still own the stock. Same way you could do this using this using the ISE options. Let's say, for example, that I had maybe not necessarily a stock, but the thing that probably my personal favorite use of these options is for international bonds. It's very common on the long-term financial planning side of the business for people to recommend to their clients, if they want exposure to overseas currencies, to recommend buying bonds overseas, whether it's in an emerging market, whether it's in Europe, wherever it is. One thing that you can do is, instead of going overseas, if you don't feel comfortable buying bonds overseas, you can buy U.S. bonds, but then with a little bit of the money that you get from the U.S. bonds, or I'm sorry, whatever interest payment that you're getting from the U.S. bonds, one thing that you can do if you are bullish on the euro, or if you're concerned about the dollar going down, you can buy puts on EUI, and then you have downside dollar exposure that way, and it's limited.
Great question from Andrew. Andrew is a recent, he is very often, he's at not only the ISE, but I think I've seen him at OptionsXpress when I've given presentations there. So Andrew has a question that's probably not so easy to answer, but I'm interested to see what Mike has to say. So if hedge funds are so sophisticated, why are they all going down, Mike? What do you think there?
Well, one thing that I've always found interesting is that no matter how good you are at trading, emotion can always play a part on it. One thing that I would recommend researching if you're looking into hedge funds is the old. If you're newer to this business, you may not have heard of this, but long-term capital management. They were a hedge fund. I think it was about in the early to mid '90s, I think, and they were making phenomenal returns. Actually, I believe one of the guys that was one of the part of the brain trust of that hedge fund is actually one of the guys that helped invent the option pricing formula. And they just could not miss. They were making phenomenal rates of return. They had found a way to beat the market. And then I believe what brought that down, if I'm not mistaken, Steve, that was when the Russian ruble collapsed. Am I right on that?
Yeah, it started with the Thai baht. But yes, you're right. First Thai baht, then Russian ruble. They had huge trades on in those currencies, and also mismatching of maturities. Yeah, I mean, I think one of the points is just that they make an assumption, I think even the option pricing model, about liquidity, right, Mike? That, when you look at that option pricing model, it assumes that you're going to have liquidity every day, and sometimes it doesn't always exist.
Yeah, you never know. And from the standpoint also, just getting back to hedge funds, I mean, they're human beings, and the people are going to make mistakes at times. Yes, they're very sophisticated, and there are some hedge funds that are doing pretty well this year. A lot of the short hedge funds are doing great, but you got to understand that they're human beings that are running it.
Andrew says the book's called When Genius Failed. Yeah, thanks, Andrew. So everybody should definitely read that book if you're interested. One other point, just remember, sometimes, believe it or not, many people are going to get into a strategy that has been very, very popular, but it may have a lot of risk. And so the one that I think of is the yen carry trade, where you borrow money, at least these large institutions were borrowing money in Japan and going into New Zealand and Australia and even the United States and investing it. And, we've seen what's happened recently, that the yen has actually rallied pretty strongly because they had the opposite trade on. So you got to be careful when you actually see a trade that everyone else in the world has the same trade on. You just got to be careful. And that's why Mike was talking about limited risk. I think it's a great way to trade because you really want to have some sort of way to limit your risk.
Oh yeah, and it's the standpoint that no matter, let's just say that I just make the dumbest trade ever. I mean, I am just a total pinhead on the trade. I know that that's the most that I can possibly lose, and that's one thing that helps me to sleep well at night when I'm wrong. It helps me to be happy when I'm right because of the leverage that's involved with it.
Faye wants to know what would be a good limited risk trade if one thinks that the long-term interest rates would be going up, although maybe even lower in the future. And as you pointed out, Treasury bills, if they go any lower, they'll be negative. And but do you have any thoughts there?
I mean, the only thing I could think of right now, if you wanted to trade options on the Treasury futures, one thing that you could use, you can trade futures options in your account at OptionsXpress if you get it futures options enabled. So that's one thing that you can go about doing. And in terms of doing spreads, you can do them. You can do options on futures just like you could on stocks or on the currencies or anything that we discussed tonight. So in terms of setting up a spread, you could set up a vertical spread. You could just buy calls, or if you have the ability to be by your computer enough and set up your stops, you can trade the futures themselves. But I do know that there is a product out there that is for that. I also know that from the standpoint, there's not a ton of liquidity with that product right now. If you're looking for liquidity, you're probably better off trading options on the futures themselves.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.